Good evening, everyone, and welcome to the webinar. This is Sara Waqar. I am a financial markets trader and a mentor. I've spent over 12 years teaching people from all sorts of backgrounds on how to trade effectively and with consistency, how to execute risk management principles, and how to build trading discipline. Licensed from FINRA in USA and from ESCA UAE as an investment manager. And I usually trade in derivatives, in currencies, commodities, and stock indices. Welcome to Amana. We are a brokerage which has a 15-year track record of delivering the best trading platform executions and overall trading experience. We've got multiple regulations, both locally and internationally. We have DFSA and ESCA from the UAE, and we have from Europe, CMA from Lebanon, LFSA from Malaysia, and also the Mauritius regulation. We have a special focus on the MENA region, and we offer both regional and international stocks. We have over 5,500 instruments, which are both leveraged and unleveraged. And these are across commodities, currencies, indices, ETFs, and even ready-made portfolios such as Amana Invest. So if you have any questions, you can drop them in the Q&A section below, not in the chat, but in the Q&A. And if you want to get in touch with us, you can email us at support@amana.app, or you can call us, get in touch with your relationship manager, or you can approach us through live chat from our website. Now, before I proceed with today's webinar, I would just like to tell you that we are going to have an excellent promotion in June, and that is a weekly lucky draw for iPhone 17 Pro Max, and that starts in June. So if you want to be eligible for it, you need to be a UAE resident, and both if you are new and if you're an existing client, you are still eligible in both cases. What you have to do to be eligible is to deposit a minimum of $200 in your trading account, and that should be Amana app, not MT4. And you have to place a minimum of one trade during a week to be eligible for this draw. And this is going to happen every week on Monday. So it will be the 8th, 15th, and 22nd and 29th. So these are the dates, and so it's going to happen 4 times. And I think it's a very exciting opportunity, and the fact that it's going to happen every week that increases your odds of winning. And if you want any additional information, you can always email us or get in touch with your relationship manager. So let me now proceed with today's webinar, which is about stop losses and order types. Please read this disclaimer before we proceed with the webinar. So the first thing that we're going to discuss is the different types of orders. So as you know, before placing any trade, you need to understand the different ways in which you can enter the trade. And every different type of order is going to serve a different purpose, and it carries a distinct advantage and also a trade-off. So it's very important to know which type of order to use depending on your entry, upon your goals, upon your price action setup, your risk reward objectives, etc. Because using different types of orders is going to alter all of these objectives. And I think it's a very practical skill that you as a trader should understand when to use each type of order. So the first one is the market order, which we all know. And in that, we just enter the market at the current price, and but we might get filled at a slightly different price, which is called slippage, because the market might be fast or volatile, so we don't get that exact fill. But what we are guaranteed is that the order will be executed. So when we come to a limit order or a stop order, these orders are pending orders. So these orders are orders which might not be filled, but they have certain advantages. So a limit order is basically going to allow you to fetch a better price. That's the most simplest way in which I define it. A limit order always allows you to fetch a price better than the current market. If you're a buyer, you would always want a lower price. If you're a seller, you would want a higher price. So it will only get filled if the market retraces to your chosen level and you are waiting to let the market come to your level. So again, a buy limit order is when you are placing, you want to be a buyer and you're placing below the current market price. And a sell limit order will be when you are going to sell and you're placing the order above the current market price. So the buying order will then fill up when there is a dip or a pullback, and the sell order is going to fill when there is a rally. And the thing to remember with the limit order is it's going to give you the better price and it will give you a tighter stop loss distance, but you may not get filled if the market does not retrace to your level. And there can be times where you might never be filled during your time period. So both the limit and the stop orders, which are pending orders, do have an expiry attached with them. So you set this expiry date. For example, you 5 days or 7 days or 10 days, whatever is your window. And if it does not get filled within that, it is automatically deleted from the platform. And one important thing to remember is you should set an expiry because the market structure can completely change. And you may have completely forgotten that I have an order there. I have, pending order which can trigger. So yes, it should have a certain expiry. Stop orders, on the other hand, are like the opposite of limit orders. So a stop order is a pending order which is placed beyond the current market, which means that if you're a buyer, the stop order is placed above the current market price. And if you're a seller, the stop is placed below the current market price. And the reason for that is people trading with stops want momentum confirmation. That's the basic reason. And they're breakout traders. So there is a level and which is holding, but your idea is let the level break and I am going to ride the momentum. So what you do is you put your buy stop order above the current market price. So the current market price could be right at that level or slightly below that key level. And you're putting the order above the level. So when we go to the platform, I will show you everything and the different order types, but just want you to understand. So the key advantage of the stop order is the momentum. You get the momentum confirmation. And what is going to be the disadvantage? You don't get a good price. So you in such a case, you are giving more value to momentum over price. Let's now go to the platform and let me show you how to place these orders. So we could work with any market. So this is WTI, which is American oil, or we could choose Brent. So this is Brent crude, and then we click here. We have to, enter any position size. So if I do 100 barrels here, I can put my chosen price here in this tab. If I don't, it will execute at the market price. But if I do, for example, oil right now is trading at $102.9 per barrel. So I want to enter, let's say I want to buy at a better price. So this is not a recommendation. I'm just giving you an example. Market price is 102. I want to buy. That's the first thing you have to decide, sell or buy. The second is I want to buy below the current market. Let's suppose I want to buy at $100. So I will put my price here and automatically it will define for you the type of order. So you don't have to define the order type. See again, if I put the price as 100, it says on top buy limit and below as well buy limit. So it's automatically telling you this order is a buy limit order because you're placing below the market. Next, of course, you need the protection, you need the stop loss to go with it always. So if the stop loss is below the swing point, which is below these two candles, let's suppose around 98, so I can just put my stop loss price at 98, right? And it's telling me that at this stop loss, my risk is 200. So again, what I've done right now is I haven't done position sizing properly, I am just giving you an example just of how you can place this limit order, and then we can put a take profit as well if we want, and then we will just click on buy and then confirm. And then if you go into trade and orders, so under orders you will see Brent. And if I go here, I can modify this, right? So I can modify this and I can change the stop loss, or I can change the level of price as well here, or I can change the take profit. And if I want to cancel it, then if I want to get rid of the order, I can just do close. And now my order is removed from the platform. So in a similar way, if I want to do a buy stop, then that is going to be above the current market price. So that's going to be maybe 105. So if I want to buy at 105 because I want to confirm upward momentum, this is a buy stop again, and so on. So you get the idea. If you want to sell and you want to sell at a better price, which means in this case, the price must go up for you to be sell at a better price. So then it would be about, if you want to sell at 105, that's automatically a sell limit. And if you want to sell below the current price, that's maybe at 100, that's automatically a sell stop. So yeah, if you just try this on the platform yourself, it's very easy. So if you're getting confused, you will try it once and you will understand. So if we just do a quick comparison now of these type of orders. First is the market order, which means an order which is being executed at the current market price, which will be fulfilled. And why do traders usually do that? Because they don't want to miss the opportunity and they prioritize now over later, or they prioritize speed over a better price or momentum. And if you want entry quality, which is the best price, then you will be going for a limit order. And if you want to just confirm momentum or a breakout, then it will be stop orders. So again, the insight is that limit orders will prioritize the price, stop orders will prioritize momentum, and market orders prioritize speed. Now, after this, we're going to move on to stop losses. And I think all of you know what a stop loss is. It's a preset order that automatically closes your position if the price moves against you by a certain amount. It is the most important risk management tool. And please remember, if you don't put a stop loss, you are actually not doing your risk management. And risk management is completely imperative, especially if you're trading on leverage. You should not try to trade without managing your risk. If you don't put a stop loss, that actually means there's no precise risk management being done. Yes, I know there are people who will say that we'll keep looking and we'll keep monitoring, but the idea is that once you are inside the trade, a lot of emotions come in which actually mess up your risk management objectives. So it's very hard to kind of keep monitoring, and because you are going to make different decisions based on your emotions rather than logic, or rather than the market structure, or rather than the setup. Another important thing is you cannot predefine your risk if you don't have the stop loss in place. So in the webinar on risk management, we said that the way to do risk management is we have to calculate the position size backwards. So position size, or the units, is the same thing, is going to be equal to your risk, dollar risk on that trade. So let me write risk per trade divided by your stop loss size, right? So yeah, if you don't put the stop loss, you cannot actually limit your risk on the trade to a certain dollar value or adjust your position size. So that kind of really messes up everything. So again, going back to why stop loss is important, the first thing obviously is the capital preservation. One bad trade can just wash your account out. And a stop loss is what is protecting you. It's what's defining your maximum downside per trade or on any single trade. Like I said, if you don't do it and if you think you can just monitor and make a decision, it's going to be a pretty random decision. You're not going to be consistent about that decision across all your trades. That's not really possible, to be honest. So what we have to do is we have to decide a stop loss placement before we enter every trade. And I'm going to get into what are the correct stop loss placements and and what are the incorrect stop loss placements. So again, it's going to help us so much with our emotional discipline. It's going to help us calculate the risk reward ratio. So the risk is from your stop loss to your entry, right? That's your risk. And if you travel up the same distance, if the market travels the same distance in your favor, you've made one times reward as your risk. For example, if you risk $1,000 on your trade and you actually make $1,000, that's a risk reward ratio of 1 to 1. Now, if you can't put the stop loss, really, I don't know how you can look at the risk reward ratio. So that's another problem with not putting stop losses. And then it allows you the biggest advantages. It allows you to set and forget your trade, and you don't have to completely worry about, being losing more than what you have planned. So you can just step aside from your screen, you can do whatever you want to do, and this is the foundation of calm and disciplined trading. So next, we have to understand how to place stop losses. Again, this is very important. You don't just place stop losses wherever you want to. You don't place stop losses wherever you feel like. You don't place stop losses because you want to trade a certain amount. That is also wrong, because if you want to trade a higher amount, what you will be doing is you will be pushing the stop loss up to make it tighter. And that might not be the right level, and according to the market structure, and that's just going to stop you out and you will keep losing. So the stop loss placement can't be arbitrary. Arbitrary means that I just say, okay, on gold, I'm going to put an $80 stop loss, or in oil, I'm going to put a $5 stop loss. That has no reference to the current market structure. So the stop loss is placed according to the current market structure. Again, the best time frames are the higher time frames to determine the key levels and the swing points. And what we do is we put the stop losses above or below these key levels. If I'm a buyer, I'm going to be putting it below the swing points. If I'm a seller, I'm going to be putting it above these major swing points. And like we discussed before, price action, we look at price action confirmations around these key levels or swing points, right? So we have to put the stop loss in a way that it's also fitting in with the price action formed and the key level as well. So I'm going to give you some examples right now about how to do it. Okay. So, for example, this is a swing point, right? This is a point which is swinging the market from coming down to going up. And if somebody were to take this as a bullish signal, looking at the downward wick, or maybe after some formation of subsequent price action or candle patterns, whatever, you were convinced that, okay, I want to get in the trade, then one stop loss placement could have been below this swing point. So this is a one stop loss placement as a buyer. And then if you're somewhere here, we have like 2 wicks in succession, which are indicative of bullish pressure. I could put my stop loss here. So this is again just examples, and it's gonna vary with the market, with the structure of every market, and obviously it's gonna vary with your strategy as well. But I'm telling you the basic guidelines. So if and yes, these might not be the only stop loss placements. We could have more aggressive stop loss placements at time, but if you are more confident in your strategy and you have good reasons for that. So let's go to another market. Let's go to gold, for example. So this is a major swing point, but then again, you do encounter problems if the range of the price action is very big. The stop loss is going to become really big, which is going to reduce your position size. So again, the formula for the position size is your risk per trade divided by your stop loss size. So if my stop loss size is so big, for example, looking at this candle here, if I'm putting my stop loss below this, right? Here, And suppose I'm entering somewhere here. This is like an extremely wide stop loss. It's going to really, make my position size really minuscule because there is mathematically a inverse relationship between stop loss size and the position size, as position size equals risk divided by stop loss size. So in this case, there are certain things that you could do. Okay. One way of trading this is by pushing your entry down with the limit order. So, how somebody could trade this would be that instead of entering higher, they could put a buy limit order at this level, around this level, or around 50% of this. Okay. So if I put a buy limit order here, what's my assumption? So this is my stop loss again, and this is my pending order entry, right? My assumption is price could come here, hit my level, and trigger my trade, and then go up for a buy limit order. But as you can see, that did not happen. Okay. What you might do is you might for very big, or you can say volatile price action, you could put a limit orders at around 50% of their ranges, such as big wicked candles, or you could put it a little bit higher. So we see on the next day the price retraced, which does make our stop loss size somewhat smaller. But then again, this is kind of like an outlier. This is a very big fluctuation or a very big range. So more experienced traders might actually put the stop loss here, but that is for more experienced traders after observing this price action together in conjunction, because this is again bullish and this setup is again bullish. So again, for stop loss placements, if we go back, could be again below major swing points. So if you're trading this setup, it's going to be below here. If you're trading this setup, it's going to be here. If you're trading this swing point, it should be below this. And again, it can be, it will vary slightly depending on everybody's strategy. So again, just as an example, if somebody's entering short on this bearish engulfer, which is a very visible bearish engulfer, you would then put your stop loss above the high of these two candles. The stop loss goes here. So as a seller, if you're reacting to this bullish, bearish engulfer, you're gonna be putting your stop loss here on top of this formation, right? Again, as a seller, if you are selling, you're putting your stop loss above this formation. Let's just do one or two more examples and then I will just proceed. In case of S&P, again, in this rally, in the recent rally, I have a promising setup here. So I have this very big bullish candle. And if you did catch this swing or this dip at its lowest level, then the stop loss would go here. But if you didn't, then there is this another formation. It's very interesting. So we have, after the price pushes up, it gives another indication of more bullish pressure through this downward wicked candle or rejector, right? If that is not enough, it's followed by a bullish engulfer. Okay. And if that is not enough, we have another bullish rejector. So we have how many signals in succession confirming the upward swing? We have 1, 2, 3, 4 in high probability price action in succession confirming bullish momentum. So if you had missed this, then this particular set of candles could have been considered as kind of like making a new temporary level. And we could have put our stop loss below the wick of this candle, right? So if you are somewhere here and the prices are somewhere here, or even here, even if you are on this day, this is a good stop loss placement, like a more aggressive stop loss placement on this particular day is here. But I would recommend that only for more experienced traders. And I think this would be a better stop loss placement. So another way of trading this rejector would be Suppose I have reached this, I'm on or this day, I will put my stop loss below the tail of the rejector. And I'm gonna, instead of entering at market, I could put a limit order. So suppose that the market is here. The market has reached this level. This is the market price. I want to buy a little bit low, so I will put my stop loss price. Let me make this bigger. Sorry, not my stop loss price, my buy limit price, like my entry price here. Okay. So again, this is my stop loss. This is where the market is right now, but I want to buy a little lower so that my stop loss size is smaller, which will allow me to go in with a larger quantity at the same level of risk. What I'll do is I could look at the range of this candle and estimate about 25 to 30% of the range, and I'm going to put a limit order at about 25 to 30% below of the range of this candle, right? And as you can see, it gets fulfilled on the and this day. So that's a way of making your stop loss a little bit tighter. So you go in with more position size, and eventually that actually means your risk reward ratios are greatly enhanced because for every approximately every 100 move of every 100 points, you are making what you've risked. So if you've risked $1,000, so every 100 point up, you are making $1,000. So please, if you don't understand anything or if you want me to repeat something, I can do that as well. Because this could be a little bit confusing, but if you start using limit orders, especially limit orders, you will understand that the market actually, most of the times, is reversing to its mean. It's not always going up in a straight line. So it goes up, but in a zigzag manner. So many times your limit orders are actually going to be fulfilled. There is always this one fear in traders that, if the market, the structure is very good and let me enter now. And if I put the limit order, it will never be triggered and I will miss this trade. But in my experience, what I've seen is that limit orders are really, they get fulfilled about 75% of the time. So market does retrace. It's going to retrace lower if you're buying, it will retrace higher if you're selling. So it moves in a zigzag way, and during those zigzags it's going to fulfill your limit order. So just to be more clear with you, I am a bigger fan of limit orders than I am of stop orders. That's because I always prioritize price levels over everything. And I always want to go in the market with a better price. And like I just said, if your limit orders will allow your stop sizes to become smaller, which is going to increase your position size automatically. And it's going to allow you to make much more money from the same trade. So your risk reward ratios are going to be significantly enhanced. As an example, let's suppose, this is your stop loss and you enter at market. Now for every approximately around 150 point when the market travels, you're going to make the same reward as your risk. But if I entered here, I entered lower, about, let's say, and my stop loss size was approximately something around 100 points, then for every 100 points that the market moves upwards, I will make the same reward as my risk on the account. So every $100 I'm going to make, and every 100 points up, I'm going to be making $1,000 because I'm trading with a higher position size for the same risk. So we've talked about this. We've talked about the logical stop loss placements, and we said you need to put them under higher time frame swing lows and highs. Under swing low if you're a buyer, and under above swing highs if you are bearish. Okay. And for people who are trading in the intraday time frames, especially H4 or H1, how do you do this? You should make sure ideally that your stop loss placement gets aligned with the higher time frames, which is going to be better. Yes, you can place stops on swings on H4 and H1, but like I said, these swings might not coincide with the higher time frame swings, which are actually reflective of the macroeconomic environment and which are more stable and which are filtering out the noise. So even if you are doing a setup on H4 or H1, just make sure the stop loss placement is such that it looks good on the higher time frames too. It's fitting the daily time frame and so on. So the key levels should be marked on the higher time frames. That's what I mean. So there is another concept called the average true range. And why we will be discussing this concept? It's that just to give you an idea about how big or small your stop loss should be. Now, the stop loss is again, it's going to vary with the market volatility. Like I said, if the market becomes more volatile, the price action or the candles will become bigger. When the candles become bigger, when you are placing your stop loss according to the candles, the stop loss size is also going to become bigger. And when the volatility is less, the candles, the ranges will become smaller, the volatility is smaller, and you will automatically start to get smaller stops, which are also going to be fitting the market structure. So you might wonder, there have been times, for example, where I would be okay with a 40 or $50 stop loss on gold, and then in high times of volatility, you had to settle with an 80 or $100 stop loss. So the stop loss size actually doubled because the volatility was there, and I don't want to get stopped out. I want to just follow the market structure, right? So the average true range is it's an indicator and it's a volatility indicator. So let's go here and let's try to put that indicator here and how it can help us. So you can search it up for here. Here you go. Okay. So you can see this line here, and then you can just also check the settings and make this more visible. So what does this show? So markets move an average range every day, okay? And this is measured by this average true range indicator. If your stop loss is narrow, then the market's typical daily movement, then you will be stopped out. But if it's you'll just be stopped out because of the fluctuation itself or the noise itself, and it's not because the market generally moved against you. It's not because your thesis or your setup was invalidated. It's just because you just put a very tight stop loss, and in the normal fluctuations or the noise, you just got stopped out. So how can you avoid that? So you can use this, and this is this the average true range measures the average price range over a certain time period. In this case, the default setting is usually 14. So it's measuring the average price range over 14 days, 14 trading days. And your stop loss should be actually more than this. It should be more than the current ATR value. This ensures that you are kind of taking into account the normal volatility of the market, and you are allowing your trade some breathing space, right? So if it's a very tight stop loss, you will just get stopped out because of the normal fluctuations. But if you allow it to be slightly wider, but not that wide that it will affect your risk reward or position size, you actually have to find a balance. And that will come when you keep practicing how to put the stop losses. So, as an example, on this particular day, this is Thursday 18th, the average true range was 83 for S&P, right? So what does that mean? That your stop loss should be ideally more than 83 points. And if I look here, this is a volatile day. This is 31st of March, right? What's my average true range on 31st March? Oh, yeah, it's 128. Okay. So it means that your stop loss should be more than 128 points. Otherwise, you might just get stopped out because of the normal fluctuations. So this is just an estimate. I mean, it's just a way of you trying to understand, how big my stop loss should be. Because like I said, the tight stop losses could just stop you out. Then just going through the rules, one important thing is once you've placed the stop loss and calculated your position size accordingly, you cannot change your position size when you are in the trade. Now, changing your position size is going to mean, changing your stop loss is going to mean you are increasing the risk on the trade. So then once the stop loss is in place, there's no concept of dragging it down okay, which is going to increase your risk. What you can do is actually to drag it up in a buy trade. And when does that happen? That happens if you have a one times reward as your risk. So suppose you're risking $1,000, again, the same example, and you have made $1,000 of profit on the same trade. Now, what is a good idea is to trail your stop loss to the break even point. So yes, you can do that. You can change your stop loss and bring it up to your entry point. And that is a very powerful technique. What that does is it makes your trade riskless or risk free because now your stop loss is up a little bit above or at your entry level. And actually, that, and yes, if you're riding a rally and you're letting your trade run, then you can keep trailing your stop loss upwards if you want to stay in the trade. And what is the advantage? The advantage is it's going to keep locking in your profit. Even if the market goes against you and hits your stop loss, that you're going to be out of the trade, but with some locked in profit. So, and how you should do the trailing is you again, it should not be very tight. It depends. If you've reached a point where you think you've made the maximum gains, then you can towards the end you can have a tighter stop loss. But if you want to stay in the trade, you believe there is a rally, you believe the rally is going to continue, then you could just trail the stop loss, looking at the price action, looking at the key levels, looking at your stop loss size and everything. So that is again something that's going to be very specific to the trade and to the chart. Okay. Yeah. So again, you could, as a buyer, you could trail your stop loss up, but not down, because widening it would mean you are just increasing your dollar risk that you initially fixed. Now, we will go look at a little bit at stop orders and why we need stop orders. So I did just discuss the limit orders and they make sense because what we're doing with limit orders is as a buyer, we always want lower prices, and the limit order allows us to fetch lower prices. As a seller, we always want to sell high, and the sell limit order allows us to fetch a higher price. But what about stop orders? Now, stop orders are opposite, right? So, why would a buyer want to buy higher? Why not lower? That's the question, okay? Now, stop orders are very specific to certain price action setups. And I actually use, but I personally, I'm not a breakout trader, I'm a retrace trader. So I like to um, get get the best price rather than confirmation or momentum confirmation. But everybody's different and everyone's trading strategy is different. So people who use stop orders more are they just want more momentum confirmation. Okay. So what the concept behind is this, you've got a certain level which the market is obeying, and you understand if there's a breakout from that level, then there's going to be a very aggressive move. So what you do is just to confirm the breakout, you put your order above that resistance level, because only once the resistance level which has been holding for so long, only once it breaks will your order be triggered. And your idea is that the break of this resistance level means an aggressive move in my favor, and this is why you would be putting stop orders. So again, the idea is all about momentum confirmation, and the idea is you not being, you don't know when that will happen. You want to walk away from the screen. You're going to, you just want the market to just execute the order for you. And so I will give you an example. So stop orders can be used well when there are consolidation setups, like price has or candles are juxtaposed and they are coiling and at a certain price level or range for some time, and you expect a breakout. So I will just give you an example. If you look at this setup in S&P 500, and this was a recent setup, you see the inside bars here. Do you see these inside bars? So what's an inside bar again? There is a candle. It's followed by another candle, but the second candle is completely within the range of the first candle. This is called an inside bar. So this will be the mother bar and this will be the baby. So this the mother can have more than one babies or candles inside of it. So on this particular S&P setup, which was more recent, you can see this whole 1, 2, 3, 4, 5 days, which represented consolidation or inside bars. So inside bars do represent consolidation, and when the setup extends over many days, it becomes more powerful and it can actually break up. So usually, such setups are traded with stop orders, pending stop orders. And how do you do that? You put the stop order on top of, in this case, because you're a buyer and you want this consolidation to break. Let me make this bigger. So we're talking about this consolidation. The consolidation means prices are at the same level. They are just resting and pausing before they want to break out in the direction of the trend. So on these days, how you could use the stop order is, as a buyer, you could put the stop order here above, a little bit above this mother candle. So the whole idea is if prices break upwards, then they will just keep pushing upwards more aggressively. There will be a breakout. I don't know why I can't. Yeah. So you could just put it here or a little bit up, right? So your idea on this or this day, your idea would be, if the prices push up, my order will be triggered and I'll be able to ride that momentum. So again, remember that you could trade inside bars that way, but it's better if you've got rejectors with those tails, it's better to trade them with limit orders. And I will just explain that. So stop orders, like we just discussed, is when you've got a consolidation, put the stop order on top of the consolidation, and again that's going to confirm when it breaks. Okay, again, what this slide is showing us, that it's actually showing us the benefit of limit orders. Now we're back to limit orders. So limit orders again are opposite of stop orders, and they allow us to buy better prices. And this is an example of two trades. So this first trade was done at market price. There's no limit order used. The market price was this, and the stop loss was here. And the market travels up to this level. So again, this is the stop loss, this is your entry, and the market has traveled up till here. So your risk reward in this case is 1 to 1.5, because the green area is 1 to 1.5 times the red area, right? Here, what you've done is, for the same trade, you have entered with a limit order. So what you did was, instead of entering here, you put a pending limit order, a buy limit order here, and it got triggered. So this was your stop loss. This became your entry after the trigger, and then the market traveled up here. And as you can see, your reward, the green area is 3 times this area. So your reward is actually much higher. It's double of this. So you'll end up making double money on the same trade with the same risk, with the same move, just because you used a limit order and you were able to get in at a lower price, which made the stop loss size smaller, and your position size then automatically becomes bigger from the formula, which is used to calculate the position size. So again, limit orders are actually very powerful. If they get triggered, they will actually give you very good results. And again, another example of using a limit order. Now, limit orders can be used nicely on the candles with the tails, especially with long tails. So what you do is, your stop loss always has to be below. And if you're entering as bearish, then your stop loss is going to be above the tip of the candle. In this case, we're just assuming that we are buyers. So the stop loss should be here. Now, the stop loss should not be pushed higher up, because again, that is going to become risky. Why should I not put my stop loss here? Why can't I? Because if the price is here, why not here? Why here? The reason is that prices have once tested these levels, right? So they have actually gone down, they have actually touched all these levels. They have the tendency to again test now. There could be a situation where the prices might actually touch all those levels again. So what we do is we put the stop loss at a place where the price has not touched. So by the way, this is a little wrong. The stop loss is gonna be, it shouldn't touch the tail, it should be a little bit below the tail. And if there is some key level or other candles around here, just put the stop loss even below their lows. Okay. So it depends. So what do you do? Where do you enter? So there are two options. Enter at market with, so this is the market price, but then your stop loss size is too wide. The other option is put a limit, a buy limit order at around 50% of the candle. Or if you think it's too large and 50% is not going to be fulfilled, you can put it here at about 30% range of the candle. So the 30% range is a very good, I think it gives a very good fill, to be honest, right? So coming back, if we put our entry here, the stop loss size becomes just this much. If I were entering at market, then my stop loss size would be all of this. But if I'm entering with the limit order, it becomes smaller and makes my position size automatically twice. If my stop loss size halves, my position size automatically doubles, and I'm gonna get the my risk reward also doubles for the same risk, for the same movement as well. So yes, you should try this. And also let me know if you have any success. So moving towards, just understanding the basic differences. Stop orders are used to confirm momentum and they're usually used in breakouts. What are you sacrificing in stop orders? You don't get the best price, right? But here, the momentum confirmation is more important to you than the price. You think, if the momentum is not confirmed, my trade idea is invalid. So you sacrifice the price precision for the momentum. But for the limit orders, you are entering at a very good price and a tighter stop loss. What is the sacrifice? The sacrifice is, yeah, your order might not be filled. So there is a chance that the price might not come down and touch your order. And that does require some patience on your part. So I would say that you should observe at least 3, 4, 5 days and the price action, because sometimes it doesn't get filled the next day. It can take 2 or 3 or even 4 days to get filled. Sometimes I've seen it get filled after maybe even 8, 10, 12 days. So it depends. But at the same time, you have to keep an eye on how the price action is evolving or how the market structure is changing. So again, let me go over how uh, we are going to execute the trade. The first thing, as I always say, is to identify the overall market structure and the trend and be in line with the trend. The second thing is look at which are the key levels where price could actually dip to, or in case of a downtrend where it could, which level it could pull up to. Now, at these key levels, the third thing to do is look at the price action. If you're looking for a buy entry, then you would be looking for bullish price actions like a candle with a downward wick or bullish engulfer or even inside bar, strong inside bar formations. And the same for bearish entries, right? But in that case, you'll be looking for bearish signals. The fourth thing then to do is your risk management. The first part of your risk management is the stop loss, where to put the stop loss. So once you've learned now with me how to put the stop loss, once you do that, calculate your stop loss size and your position size according to your fixed risk. And once you do that, then you can execute the trade. Again, you might at this point decide that you don't want to enter at market, you want to put a limit order instead, or you want to put a stop order instead, and this is where you do it. So again, if you put the limit order, then the stop loss size is going to be calculated according to the limit entry. Or if you put a stop order, then the stop loss size will be calculated with the stop entry. And that is going to, help you increase your returns and your overall risk reward. So what have we learned from today's webinar? Again, is the first thing is stop losses are completely mandatory and every single trade needs them. And they are imperative if you have to protect your capital and if you have to remove emotions from your trade. Secondly, stop loss placements are not arbitrary. You just can't go and put them everywhere. You have to study the market structure and you have to place them accordingly. Then we learned different order types and we talked about how using these different order types in different situations can actually improve the risk reward or it can lead to better results. And the most important thing is the stop loss is decided first, then it is used in the calculation to determine your position size. And that is the whole idea of risk management. Without deciding the stop loss first, you can't even work out your risk management properly. And yes, so trading is about controlling what happens when you are wrong. And you have to accept that risk management is the most important part of trading, even much more important than strategy. And if you master risk management, you can actually master trading. You don't, if you look at the strategies, there's so many different strategies which can actually work or given, work to help you predict the markets. But where do traders mostly go wrong? It is mostly not to do with prediction of the market. It's mostly to do with not managing your risk, not putting your stop losses, not calculating your position sizes. Yeah. So this is the most important thing that we should be doing as traders. So thank you so much for the webinar. And I am now going to be seeing you after Eid on Tuesday. Thank you.